when we're in a premium or discount and we have low resistance liquidity or trend line liquidity to target on the opposing side, you're better off going for the reversal. Everybody wants to know how to anticipate when the market is going to reverse and when the market is going to continue. And that's the focus of today's video. I mean, really guys, the markets only do one of three things, right? They trend up, they trend down, or they move in a range. And a lot of traders, including myself, I like to trade mainly reversals. Although if you've clicked on this video, you probably want to understand, how do you time these reversals? How do you time these continuations? And how can you anticipate with the highest probability, that's the key, probability, that the market's going to do one of those two things? Let's get into it. Now, the easiest way to anticipate whether you should take a reversal or continuation is by learning the concept of dealing ranges. So ICT's talked about this. I've discussed this many times on my YouTube channel, but I want to actually unpack this today a little bit further and discuss it. The markets are printing live. It's Asian session, 11 o'clock in the morning here in Australia, but it still applies. So what you need to do is you need to go on the 15-minute chart. That's the first step. And just mark out the previous highs and previous lows. So I've done that here with blue and the low is in red. I'm going to do that again right here. So I'm going to mark out the high in blue and then the lowest low of the range in red. Now, there's two factors. I'm going to ask you guys some questions. Firstly, when price was down here, were we in the bottom or top portion of this range? When price was down here, we're in the bottom, right? So to simplify it, if you want to take a reversal, look at the 15-minute chart, and when you're in the bottom of a range, look for longs. In contrary, if you look at the top here, when we're in the top portion of the range, we look for sells, right? So that's the basic principle. You use dealing ranges and premium and discount to determine what's the most likely course of action. Again, a lot of people have this obsession that they need to have a way to take every single market movement, every single trend they need to take. That is not the case. Wrong. You need to have a framework, and I need to have a framework that occurs more than 50% of the time. That occurs more than 50% of the time to anticipate a reversal or a trend continuation. Let's dig a little bit further. So back onto this first dealing range here. Price obviously is sitting down here at the bottom. You can see that. Just because we are in a lower portion or higher portion of a dealing range, yes, longs are favorable down here, but it doesn't mean you have to take a long. You still need to wait for your entry criteria. There still needs to be something you can enter off. So if you have a look today at market open and we go back onto the 1-minute chart, yes, at open, I was looking for longs and I was happy to take a play during the opening range. But what does price do at open? It expands higher. Can you really capitalize on that now? Can you really take the move to these buy side points that you wanted to? No. And so at this point, when price now engages the top portion of the range, there's no longer buys to look for. Sells are more favorable. And as the price moves, the dealing range also changes. So as we print up here, this now becomes the lowest low, and this now becomes the highest high. And all you've got to do is to grab your Fibonacci, go from the swing high to the swing low, and mark out the optimal trade entry. That gives you a really deep premium or a really deep discount on either end. And so when price at the top here, we're not looking for buys. Could price just shoot up from here? Yes, but it's less probable. Does that make sense? And trading is all about probability. So at this point in time, when the market's at the top here, I would be looking for sells. But are there any opportunities to go for sells? Not really. There's nothing here that stands out. As price is coming down, it's generating low resistance, which again is our main target. So this is conflicting. This is conflicting in terms of what we're looking at. The market's moving up and down. Yes, we're in a premium. Yes, we're in a discount, but it doesn't mean there's going to be an entry. I want you to write that down. Just because we're in the top or bottom portion of a range does not mean there'll be an entry. But this allows you to anticipate what the market will do. And if there's an entry that suits your criteria, then you can look at taking a trade using that basic principle. That is the crucial point. Again, too many people think you need to take every move. It's not the case. So as price plays out, you can see what's price do. We're accumulating. Price is working up and down, up and down. You don't want to be involved in any trades here because, again, you're looking for trades from the swing points of the highs and the lows. So when we're looking at price up here, if you can take a sell from somewhere here, great. If you can take a buy from somewhere down here, great. But if you can't see anything that suits your model, there's no trade. And yes, you may have wanted price to go down, and it did, It doesn't mean something is wrong with your strategy. It doesn't mean you have to fix anything as a trader. It means you did what you had to do correctly. That is the bottom line, because you stuck to your edge, you stuck to your strategy, you stuck to what you know in terms of what your data collection suggests. Now, we've just actually ended a macro from 950 to 1010. So why not talk about the price where it currently is? The market is printing live. You can see that here. And let's apply that idea. Now we're on the 1 minute chart. So this here is the highest high. Let's mark that out in blue. This here is the lowest low. Let's mark that out in red. Again, ranges, like anything when you trade ICT, they're fractal, right? They're fractal. And what trading is about, guys, is about putting yourself in the highest probability position. It's not about being 100% correct. It's about having the highest probability. And just to summarize what we've discussed already, we've discussed the fact that, look, if we're in premium, look for sells. If we're in discount, look for buys. But even if we're in those ranges, you still need to have an entry model that you like. And if you want an entry model, I've used consistently inversion fair value gaps, macros, plenty of videos of that on my YouTube channel if you're new here. But if not, check those out. There's plenty there to work off. But what would you say here? What would you say here? This is the high and then this is the low. Would you be looking for sells down here? The market's already moved down. Would you be looking for sells or would you be ideally looking for longs? For me, I'd be looking for longs. That's it. And all I'm asking myself is, okay, if we're in that level of premium, if we're in that level of discount, does the market give me a reaction that warrants that reversal? Now, there's options here. As the market's printing live, you can see that. There's probabilities or things that could play out. Price could do this, but what else could price do? Go straight down. If price shoots down another 300-400 handles, does that mean I'm wrong? No. That just means that the market conditions did not suit my model and I'll move on to the next trade. So down this far in the range, I'm not looking for continuations. I'm going to put a little screenshot on the screen here and I want you to take a photo, pause the video if you need to, because we're going to move on from this. But these are 5 things to study. And again, study these things, join the free Discord for this week only. I'll respond to everyone. If you're serious, take the time to study, look at your charts and find examples of these things that indicate a reversal. So we've got the power 3 here, that's fine. We've also got this space. I'm going to call this space the volume imbalance that's created from the new week opening gap. Does that make sense? And I could narrow this down into this spot. This is the liquidity void because there's no wicks. And you can see what price has done. We've come back into that liquidity void. We've come back into discount. Longs are more favorable. We've got low resistance liquidity to target. Again, low resistance liquidity is one of the main things. And plus or minus 5 minutes out of the macro as a reversal, we've got that. So everything here is fine. And literally this would be a long position right from here. Your stock could go below these bodies and you could try to go for a 1-to-1 and then hold runners to these buy side points. Now, is this an 100% win rate strategy? Is this an 100% way to anticipate what will happen? No. But here's what I'm going to say. And this will be the final point of this video. And then we'll come back with the results of how this trade plays out. Notice how this is the very lowest portion of this range. And notice how we have all this low resistance. And notice how this is quite a big space, right? It's a new week opening gap liquidity void. Now, if price were to do this, I'm going to draw a few things out. This is the initial reversal. I prefer to take that initial reversal. However, a lot of the times you may not be on the charts or you want to wait for more confirmation. So you see this initial reversal and then price may do this. And then price may do this. Anything from here onwards, if we come up and we pull back, I would be waiting for price to generate more liquidity on a smaller time frame to then target. And then what you guys would be doing, or what I could do, is to look for longs from here or look for longs from here. So right now, this is the initial reversal point. And why am I thinking of this reversal? Why do I think price is going to do this? Let's break it down. Firstly, we've got the range, right? From high to low. Lower portion of the range. Second thing, we've got this new week opening gap volume imbalance, which I treat like a fair value gap. Third thing, we've got accumulation manipulation, right? So we've got a power 3. And lastly, we've got everything we need to see on the small time frame. So if I was to mark out the macro here, which is from, let's do this, from 850 to 910, plus or minus 5 minutes, we've got a nice macro reversal. And notice how we've got nice impulse from this area. These are all things. That's all you need to know. You don't need to crack the algorithm. You just need to know what is more likely based on what the market's doing. And my entry there, if I was entering that, would be called a close proximity entry. To be honest, I think entering from here is valid from here. because by that point, you've actually got a CISD. So I'm going to mark that out here for you guys. You've got a change in the state of delivery. So that's it. That's all you need to know. Use dealing ranges, use premium and discount, use low resistance liquidity, and then look for impulse around key timeframes that indicates the market wants to move with your narrative. That's all it is. And in terms of taking reversals or continuations, this trade here would be a reversal because it's the first pivot at the lower portion of a range, whereas a trend continuation would not be the first pivot, but it would be after price comes up already, trickles back down, and wants to continue the move, provided there's still low resistance. If there's no low resistance above, there's no target. There needs to be liquidity to target. Now, why would I take a reversal here, not a continuation? Well, the main reason is we're at the lower portion of the range, and my data collection suggests that when we're in a premium or discount and we have low resistance liquidity or trend line liquidity to target on the opposing side, you're better off going for the reversal. Does that make sense? If there wasn't low resistance here, then maybe you can look for an entry model lower. But for me, because of the low resistance, because of the power 3, because of this perfect reaction, it makes more sense for me to take a long or discuss a long. Anything up until the halfway point of the range, which I can now move this here because we've formed a swing low. Anything up to and including the halfway point of the range, I would continue to take longs. And let me elaborate that one a little bit. So for example here, this is the range from high to low, and this is the halfway point, like this. I would feel comfortable taking trend continuations up until this halfway point. Say for example, price does this, pulls back and does that. I would be happy taking continuation from here to here. If price was up here and then trickled down like this and did that again, I'll just risk less, because as you work up the range, there's always a potential, as we know, for the premium and discount to offer a reversal. So the best reversals happen at the lower portion of the range. The best trend continuations happen underneath the 0.5 of the bigger range. You combine those two things together, you have yourself a high probability way to anticipate when the market will reverse, when it will continue, and also how to execute those trades. There is so much opportunity in the market to take what you need. The hard part for a lot of people is accepting that you won't always be correct, and accepting that not every opportunity, not every premium or discount, not every engagement requires a trade. You have to take the trades that make sense to you based on your data collection. Today we discussed a few. We discussed the initial reversal down here, pullbacks, and then taking that continuation. And this here is another continuation framework. SMT, inverse fair value gap, low resistance, perfect, and narrowing the macro. So I may move that up a little bit more because I want to try and squeeze as much juice as I can. I'm just going to keep trailing my stop. So I've secured regardless 10 handles, and now we'll see what the market wants to do. But really happy and satisfied with that trade. Pretty happy with it, and there we go. So hope you guys got something from this video. This illustrates a trend continuation model that I take. Overall, this was the trade. So long position roughly from here. Stop started down here. Full TP was there. But ultimately, the stop moved quite aggressively quite early on. Until next time, guys, hope you enjoyed this video. Have a great week. Start the week strong, and we'll talk very soon. Peace out.